Hi, Wayne here. I often get the question about how much should I trade of my account size? What's the pip value? So I put this chart together to kind of give you an idea. Depending on the different account sizes, I went from 500 to 2,000. Not sure if anybody would be trading higher than $2,000, but just to give you an idea and talk a little bit about leverage and margin here. If you watched that lesson 1 video, I kind of went over that a little bit. But it's kind of important if you're going to be trading live. So I started with a $500 account, and you probably shouldn't be trading more than 2 to 3% of that account size on any one trade. You want to grow your account slow and steady. If you're too aggressive, trading 10, 20%, you could blow it out very quickly. I'm sure some of you have experienced that before. So if you're trading 2% of a $500 account, the pip value you should be trading at is 0.01. That would be 10 cents a pip. Okay, the leverage it's going to take on 50 to 1 leverage is what U.S. brokers offer, and even the U.S. brokers do not offer 50 to 1 leverage on every pair. You have to check because on the USD Japanese yen pair it's only 25 to 1. On the pound US dollar it's only 20 to 1. Some are 33 to 1. So it does vary. You don't get 50 to 1 on every pair. So that would take $25 to get into that particular trade at 50 to 1. 25 to 1 it's $50, and at 20 to 1 it's $62, and that's on one contract size. If you were to do 2 contract sizes, this would double, 3 it would triple. That doesn't mean you're going to lose this amount. It's just some amount the broker is going to put on hold on your account. You will get that back when the trade is over. I did this chart based on 100 pip stop loss. If the trade were to get stopped out, you would lose $10 at 10 cents a pip. It would be a $10 loss. If you're trading 3%, I would still trade only 10 cents a pip. If you're trading 4%, it would go up to 20 cents a pip. If you were trading 5%, you would still be at 20 cents a pip. Okay? As your account increases and you get to $1,000 and you want to trade 2% of that, you would start at 20 cents a pip. And notice your margin requirements are going to get higher because now you've increased the pip value. At 3%, you could trade 30 cents a pip, which would be 0.03. At 4%, it would be 40 cents a pip, and these would be your margin requirements. And at 5%, it would be 50 cents a pip. Now, this is how much the broker is going to take out of your account. I will try to max the trades on my copier to 3, because if you were only getting 20 to 1 leverage on the pair, and I was in 3 trades, they would actually take $930 from your account. Once again, you wouldn't lose that, but that is put on hold, okay, kind of as collateral as your account. You notice when you get into a trade on Nadex, they take the whole thing out, okay, and Forex they only take a percentage of that out because you get leverage. So even though you're possibly trading more than that, there'll be $930 put on hold. The maximum you would lose would be $50. The trade would be $150 if all 3 were to get stopped out at 100. Okay, but I just want to make you aware of that. Okay, at $1,500, at 2%, you could be trading 30 cents a pip. At 3%, 40 cents a pip. At 4%, 60 cents a pip. And at 5%, 70 cents a pip. If you're up to 2,000, you can get all the way up to $1 a pip. So hopefully this chart helps out with what pip value you should be trading at depending on your contract size. And then you can also increase your lots as your account grows as well. So that's one thing. I wanted to talk a minute about, though, margin and how important it is. Let me go back to a slide here. First of all, let's go to this slide. Okay. This is Forex.com, and the brokers, whether you're using Forex.com or not, should have some type of a margin pip calculator. But this shows you Forex.com's margin on certain pairs. Notice on the Australian US dollar, the margin is 33 to 1. Okay? On the Euro US dollar, it's 50 to 1. On the pound dollar, it's only 20 to 1. On the US dollar, Canadian dollar, it's 50 to 1. On the dollar to Japanese yen, it's 25 to 1. So once again, this varies, so you have to check with your broker to the amount of leverage you're getting, because that can deal with a margin. I wanted to go back to another slide. Let's see, it's further down the road here. Okay. Let's take a look at this for a second. If you only had $200 in your account, say this account has $216 in it, and is trading at 0.05 lots, that's 50 cents a pip. Okay? Now that controls $5,000 of currency. Okay, mini lot, it's $1,000 per 0.1. That would be $1,000. This is 0.05, so this would be $5,000. Okay? So if I was only getting 25 to 1 margin, like in the US dollar, Japanese yen, my leverage, my margin is going to be $200. Okay, so they're going to take $200 out of my account. So now my free margin is only $21.68. Okay, it's because this trade is up 503 plus the balance, so the equity is 221.68. So there's 21.68. Now, if this were to decrease, this equity and free margin would decrease too. But what this is telling me, if this trade, okay, gets below, my balance gets below this margin, if it gets below $200, the broker's going to stop out this trade. So that only gives me $21.68. So if this trade were to go against me by $21.68, even though I have 100 pip stop loss, and I can't lose that much, the broker is going to close this trade. It's going to be a margin call. Okay, so that's why it's important that you don't overtrade, because it would only take 33 pips to close this trade, not 100. Okay, so the broker can close it before your stop loss if your margin gets below your equity. Okay, so if this balance gets below $200 as equity, this trade is going to close. Okay, I will get a warning. This will turn red. Okay, which means either put more money in your account or it has the possibility of getting closed. Now, if you have more than one trade open, the one with the highest loss at the time will close, and the other ones will stay open as long as, once again, you don't get below the margin. So that's why it's very important, okay, when we talk about margin here, that your trades don't get closed out. You don't want to overtrade where you're trading too much of your account and then you don't have enough in there and it gets called. So I just wanted to bring that to your attention and hope that helps. The other thing you can do here, if you go to this site here, FX Pro, it kind of gives you a margin calculator. You can put your pair in here. Now remember, a lot size if you trade in minis is 1,000. Okay, per 0.10 cents. If you're trading 30 cents, then you would put 3,000 in here. If you're trading 50 cents, you would put 5,000 in here. Then you can adjust the leverage to what your broker is giving you. Remember, the dollar Japanese yen on Forex.com was 25 to 1. Okay, so that's why I have 25 to 1 here. Then I hit calculate, and it tells me my margin will be $120 that will come out if I'm trading 30 cents a pip on that particular pair. Now, if I were to change this to another pair, let's say we went to Euro US dollar, okay, and we're trading 30 cents a pip, and we're getting 20. Actually, the leverage is better. It's 50 to 1 on Euro US dollar. So let's put that in. Then I would need about $74 for that particular trade. So this may help too if you go to fxpro.com and or just type in margin calculator in your Google search. You'll get these sites, so that might help too. So hopefully that helps a little bit as far as the PIP values of how much you should be trading to your account. Like I said, I'll try to keep the maximum trades to 3 so nobody runs into any problems with margin calls and so forth. So if you have any questions, let me know. Hopefully that helps a little bit. And I'll also post this chart in the Traders Lounge as well, so you can look at it. Okay, talk to you later.